But let's get back to our chat with our personal finance expert, Sumeet Vaid of Freedom Financial Planners joins us now. Sumeet, hi. Thanks for being with us. Post the recent RBI curbs, the opinion is that money would start flowing from bonds into FDs. So now everyone will redeem their bonds and move them back into the safe haven, which is FDs. There are any number of corporate bonds n number of corporate bonds being introduced at this time. But what would your recommendation be on where one should be putting their money?
You're spot on. Usually the reaction happens post the event, and which is what is going to be the case at most of the individual families level. And I don't know whether that will be a right strategy, because whatever that surprise action by RBI has to happen has happened really. And now post that event, now if you move out of your existing bond funds where you already incurred losses and move into fixed income or fixed maturity kind of instruments like fixed deposit bonds, I don't think so that'll be a good strategy, because you cannot be a reactive investor. You have to have a strategy in mind and stay put and carry it through. And even after those events, if you are in existing bond funds, whether short term, long term, the chances of having a capital erosion over a longer period of time is almost negligible. In most of the bond funds, what happens is, because of these events, initially you will have a negative return, but then the carry comes in, and that carry really helps you to go and generate returns over a period of time. So my advice to those investors who are already existing in bond funds is not to redeem and now look at any kind of other instruments like fixed deposits. Stay put, recoup your returns, and then think about what your risk appetite is to the volatility, and then decide for future accordingly.
Okay. Well, some statements coming in on divestment, but they're self-explanatory. Let's shift to our caller. Arun Kumar is calling us from Mumbai with his personal finance question. Go ahead, Arun ji.
Yeah, hi, good afternoon. My name is Arun Kumar.
Ji.
We had a property which we sold. This was purchased in 2000, the year 2000, 13 years back. And we just sold it this year, that's in 2013. Just wanted to know what is the capital gain implication and how do we go about, dealing with this property issue. We want to buy another property this year only, or maybe in next 1 year.
Okay, so that should.
And anything on the marketing softening will the market go down? Do we wait? And the tax part, the tax part is what I wanted to know.
Okay, go ahead, Sumeet.
Arunji, since you mentioned you had this property for more than 3 years, which I heard 2000 odd when you bought, so it's close to 12 years now since you had property. So you'll be applicable for long-term capital gain tax, and within that, if you really use indexation, which is the inflation impact, you'll get 20% long-term capital gain tax with the indexation benefit thrown in. So it'll be a pretty interesting to note. In my view, it will not be a big tax on you, because it's been really held for a long period of time. Having said that, I'm also hearing that you're saying that I'm looking at buying property. So if you can really go and buy a property within 2 years of selling the earlier property, you don't need to pay this capital gain tax, because the proceeds of property, if reinvested again in property, this tax really gets planned much more better. So our suggestion will be, since you're looking at property, stay put with the property itself, because property as an asset class has really done well. Whatever said and done in India over last 2-3 decades, that's one asset class which is consistently performed, and looking at Indian demography and looking at the kind of demand supply gap it'll continue to remain to be a good investment. So you can continue to look at property.
All right, we have to leave it at that, Arun as well as Sumeet. Thank you very much for joining us. A word to you viewers: if you have any personal finance questions, do send us an SMS.